Hello traders, thank you for giving me some of your time here today, and I want to talk a little bit about time, and I want to talk about evidence. Okay, so time is really precious, okay, and regardless of what you might think or have been told, you're going to need to give up a lot of your time to be a successful trader. Okay, even if you have a successful strategy, it's going to take you years to build up to a level where you're making significant amounts of money. Okay, this isn't what you're usually told. Okay, you probably have switched off already because what we look for is we look for stuff that agrees with what we want. Okay, rather than what the reality is. Okay, so we're looking for the quick, get rich quick shortcuts is what we're looking for, and there's 1,000 channels on YouTube where they're going to sell you this idea, but you're going to waste years of your time, okay, following these people, and you'll never get this time back. So it's really important that when you start trading, you make some good decisions. Okay, now I'm not going to tell you what to do, but I'm going to share with you a few ideas today that might be slightly different to how you've approached trading in the past. Okay, and what we're going to do is we're going to use evidence. We're going to look at the evidence. Okay, we're going to forget what we feel. We're going to forget what we want to believe. We're just going to look at the evidence that's available. So we're going to look at the traders that we know are making money, and we're going to look at the traders that we know are not making money. Okay, and this information is all out there, but we need to start to look in the right place. Okay, so when we want to look at successful traders, we need to look at people who publish their track records. We need to look at people who've got a long track record of trading and have consistently made money over the long run. And this information out there because certain traders need to, if they're managing other people's money, they need to publish, okay, their track records. So generally, we're looking at institutional traders, we're looking at fund managers, we're looking at people that manage other people's money. Okay, in the retail world, some traders do publish their track records, but the majority don't. Okay. So regardless of how compelling their story is, we're just going to base our decisions on evidence. Okay, so when we find these traders that are making money, what we want to do is look at what they have in common. What are these successful traders doing? Because they are the ones that we want to emulate. Okay, and what you find is consistently these traders tend to have low win rates. Okay, they're not winning the majority of their trades. Okay, you tend to find 40%, 30%, or even less win rates. Okay, and the reason it's still possible for them to make profit is they all tend to have high risk to reward ratios. It's really hard to find traders with long track records who are taking profit early. Okay, having a lot of small wins. They have low win rates, and they have winners that are much bigger than their losers. Okay, and the mantra is you let your winners run and you cut your losers short, and you'll find that that's a message that most of them share. Okay, the majority of them share. The third thing is that their trading approach tends to be systematic and simple. Okay, you don't find many of these traders saying that they read the market and they work out from reading price where market's going to go, and they tend to have a very simple, structured, rule-based approach. Okay, and you find this from people managing 100,000 to 100 million. Okay. Their strategies tend to be simple momentum or value based strategies. Okay, they look for price to be rising and they buy, or they look for price to be falling and they sell. Okay, they don't have these really complex pattern reading systems to work out where price is going to go. So this is again slightly at odds with what we see from the traders that lose money. Another important factor, number 5, is patience and resilience. Okay, these traders, because they have low win rates, they go for very long periods of not winning. Okay, and then they don't change their strategy because they're in a drawdown, or they don't change their strategy because they realise the previous week, if they'd have changed their strategy, they would have had better results. Okay, they stick with it over the long run. Okay, because they understand that you can't predict what the market's going to do. The past is a representation of what might happen in the future, but it's very rarely a reflection. There's infinite variation going on all of the time because markets are chaotic. Okay, when people are presented with the same information time after time, they tend to react differently. Okay, based on how they're feeling at the time. Okay, so you've got to expect your results to vary quite dramatically over time. And the 6th factor is they understand risk. Okay, they have a deep understanding of what risk is, and what they tend to do is when they get shocks, they want the shocks to be positive shocks, not negative shocks. So if you look at the traders who like to maintain a very high win rate, perhaps by having a very wide stop and taking profit very quickly, okay, it only takes a small shock like 3 consecutive losses to wipe out a year's profit. Whereas you find that the traders that make profit tend to make profit over time, the shocks go in their favour. Okay, so they'll get 3 winners much bigger than their average winner in a row. Okay, and that's because they have a deep understanding of where the risk is. Okay, the risk is in the unexpected. So here's just a little bit of information I quickly found on the internet from traders that have made profit over a very long period of time. This trader is known as being one of the most successful of all time based on his average returns, and you can see here his returns over a 17-year period from 1999 to 2016. And when you look at his returns for the year, you can see he has a lot of losing years. Okay, and he has a lot of very high returning years, 67, 43%, 108%. Okay, but he sticks to his system because his system doesn't win very often, but when it does win, it wins very large. Okay, and that's how he has maintained his track record. And this is very at odds of what you'll see with the YouTube educators and the retail traders who are selling you this story of like 60% win rate and very rarely having a losing month, never having a losing year. Okay, this is completely at odds with that. Okay, here is another one. Dunn Capital is one of my one of the most famous trend traders. And don't be fooled into thinking that you have to be a trend trader to be successful. You don't. Okay, but it fits in with the consensus, fits in with the evidence of what successful traders do. Okay, he has very large winners, he has very small losers, he sticks at his strategy through the bad times, and he accepts that sometimes he's going to lose. He doesn't try to avoid losing. And you can see here the blue line is track record, and these are his drawdowns, and look how big and how frequent he has drawdowns. But this is 40 years trading without changing his system. Okay, it's a very simple system. He just uses a simple moving average crossover. He uses a simple trailing stop. Okay, and he gets his risk and his position sizing correct. Okay, and you can see here over 40-50 years, this is from 1971, he's vastly outperformed the market. This is the S&P 500. Okay, and he doesn't just trade equities, he trades currencies as well. Okay, and there's lots of this information available on the internet, and you can go and look at their track records, and you can see that they all have these distinct factors that they all use to their advantage. Now, the other side of the coin is the traders that are losing money. Okay, and when we look at the traders that lose money, they tend to have high win rates. They tend to take profit really quickly, have small wins and small losses, and often losses slightly bigger than their wins. They have these very complex discretionary approaches where they spend hours every day analysing the market on multiple time frames, waiting for precise patterns to occur before taking their trades, because these are going to give them this high win rate. Okay, and really what they're doing is they're getting the high win rate by just taking profit early. Okay, and they have this obsession with analysis and entries and avoiding losses. You'll never hear, if you listen to the podcast of the successful traders, you'll never hear them going on about entries. You'll never hear them mention entries. The only time they mention entries at all is when they're being pushed to explain their entry system. And usually their answer is something very simple, okay, like a breakout. And you'll find that they tend to be, these losing traders tend to be impatient and reactive. Okay, so whenever their strategy is not working, they'll tend to change something in their strategy. Okay, and they should already have the evidence that over the long term how their strategy performs. They shouldn't be changing it at all. If they find a new strategy that is supposedly better, they should be diversifying and trading both of them. Okay, if you're changing your strategy or your approach after a short term of results, then you have to question why you were trading that strategy in the first place. Okay, so like I did with the profitable traders, if you go and dig around on the internet, here's the evidence of the losing traders. Okay, now this is from one of the biggest retail brokers on the planet, and this is their data from 43 million trades. Okay, and what they found was that the majority, the very high majority of their, a large majority of their retail traders were losing money after 1 to 3 years. Okay, after 3 years, I think it was a tiny percent that was still profitable over that period. And these are all of the major currency pairs. Okay, and this is the win rate of these 43 million trades. And you can see on every currency pair, the win rate was above 50%. Okay, these guys are closing winning trades more than half of the time. But when we look at their risk to reward, or their average winner against their average loser, the blue is the average winner and the red is the average loser across the major currency pairs. And their losers are much bigger than their winners across the board. There isn't one currency pair where people were getting winners bigger, not even 1-to-1 risk to reward. Okay, this is what losing traders do. They try and win often and they get out of their trades too soon. This evidence is all there for you. Okay, it's all there, but you need to start believing it. Okay, we've all seen this evidence, but somehow we think that, you know, our way of reading price, our entries are going to be somehow buck this trend. Okay, and it's not until you start thinking differently. You need to change your pattern of thinking. Okay, so, you know, what I would suggest to everyone here is just go and gather your own evidence and ask yourself, you know, are you going to waste the next 3-5 years of your life trying to do something that the evidence evidence suggests across, this is a massive study of people and their behavior, this is just 43 million trades, but if you can go and find a retail broker that has data that conflicts with this, then by all means change your view. But this isn't the only study, and everyone I've seen says exactly the same thing. Okay, but we're just not listening to the evidence. So I just want to finish off today with giving you one of my favorite trading strategies, and this was developed based on the evidence of what wins and what loses, and you'll find that it's although very similar to how a lot of people approach trading, there's distinct differences. Okay, so what we're going to do is we're just going to use simple momentum, and we're going to trade in the direction of that momentum. We're not going to worry about precise entries. We're just going to continue taking entries in the direction of the momentum, and then we're going to apply a simple trailing stop to maximize the return from the trades that luckily enough go our way. And we don't need too many to go our way, because when we get a shock, okay, when risky events occur, okay, that's only going to affect us on the positive side. Okay, so this is a simple strategy, and I'm just going to it's just something that you can go away and test yourself. Okay, so this is a 1 hour chart, and you can see here we have the daily markers on. So each of these lines represents 1 day of price action. And to determine which direction the momentum is, we're just going to look at the previous day's price action. Okay, and if that price action closed down, we're going to assume the momentum is short. So you can see on this day we opened here, we closed here, momentum is short. So the next day we're going to look for that momentum to continue in that direction. When we go to the next day, we're just going to look for some short-term momentum, i.e. a single 1 hour candle, to confirm that continued movement short. When we get that, we're going to sell at the low, and we're going to place a stop at the high. It's as simple as that. And you can see here, this was the first entry short, and this one came back and stopped out, okay, for 1 loss. When we get stopped out, then we continue to look for momentum short, and we can see another 2 attempts here, but price didn't continue short. Then we get this third attempt to go short here, and we sold at the low, placed our stop at the high, and this trade went in our direction. So once we've discovered a successful entry, the important thing is we need to let that run, and we need to maximize our profits from that. Now this is very hard to do because we've already taken a loss, and our instinct is just to recover that loss. So look, there's some support here, this little area of support, so we'll get out quickly for a 1-to-1 risk to reward. But we know the evidence suggests that doesn't work over the long run. So what we do is we place a trailing stop. Okay, so I've marked the entry here and our stop point here, and we can see each of the R returns marked out here for us. Now there's a million ways to trail your stop, and as with entries and analysis, something simple is your best option. So what I'm going to suggest to you here is you're going to wait until price closes over 3R, and you can see here we close well over the 3R, and at that point you're going to take the risk off your trade and move to break even. Then when we close over 5R, we're going to lock in 3, and then when we close over 7, we're going to lock in 5, and we're going to continue that way, okay, until price comes back and stops us out, and here we get stopped out at 5R. Now this is going to feel bad because we got close to 8R, okay, but we got 5 times our risk, okay, instead of 1. So we've paid for our previous loss and we've made for our profit. Now, if we run that over consistently over a long series of trades, that's where we're going to develop an edge, because momentum occurs and it continues. That is human behavior. Okay, and likewise on our entry, momentum occurs and it continues. And sometimes, whilst you're in these trades and you're trailing your stop, you're going to get a sudden reaction in price because of news or some other reason, and price is going to spike down here and you're going to get a massive win. You're going to get those sometimes, okay, but your loss is always going to be 1R. Okay, you're controlling your risk, but you have your potential upside is endless, essentially. Okay, what happens most of the time is you get taken out on your trailing stop. Okay, and that's very hard to do, but what we're looking for here is we're looking to base our trading on evidence and not what feels comfortable. So I hope there was some information in that's helpful for you today, and if you're starting to learn to trade or you've been trading for a long time, I just want to ask you to please look at the evidence to back up what your beliefs about trading are. And if there's a trading educator that you're following that's very compelling and his explanations seem to make a lot of sense, just ask yourself, does the evidence back up what he is saying? Okay, thanks for your time, everyone, and please feel free to contact me if you want to ask me any more questions about today's presentation.